Thanks so much for that introduction. My name's Sarah Kemmitt, and I'm with UNEP FI, where I lead the Net Zero Banking Alliance Secretariat. This is actually my first time to the African continent, so I'd like to say thank you for such an amazing experience. Certainly a experience of growth, and I'm certainly personally learning a huge amount from you all about the context in which you're operating as financial institutions. So this panel is all about climate mitigation, and I'm sure you're all very aware that back in 2015, the Paris Agreement was adopted by 196 parties, and that really committed the globe, which is very significant, to a rapid, ambitious decarbonisation trajectory. And that has the aim of limiting global warming to well below 2 degrees above the pre-industrial average and aspiring to 1.5. We're really trying to keep that 1.5 dream alive. That commitment has kicked off a race to really rapidly decarbonise the global economy and decrease reliance on fossil fuels and all greenhouse gas emitting activities. And this transition is both critically important but incredibly challenging. And it requires the coordinated efforts of a whole range of actors across a whole range of industries. But it also requires a huge amount of investment. So estimates vary widely, maybe 4 trillion a year out to 2050. I've seen estimates as high as 9 trillion though. And financial institutions really have a critical role to play here, which was the basis for the formation of the Net Zero Banking Alliance, which I run, and also the other Net Zero alliances within the Glasgow Finance Alliance for Net Zero. So fundamentally, financial institutions help their clients to effect change. That's what they're really good at. And as providers of capital, financial institutions can support clients in the pursuit of their own decarbonisation journey by accelerating the assessment of risks and impact, and also by seizing those enormous opportunities that are available as those businesses adapt and innovate. And banks in particular are developing innovative products that support their clients' own transitions, and facilitate that flow of capital to climate solutions and opportunities while responding adaptively to the short-term effects of climate change. And financial institutions are acquiring and digesting increasingly larger volumes of climate data. Corporate disclosures are improving, but there's still a huge way to go. And of course, many economies are very based on small and medium enterprises where there is a massive data void. So firms are just getting to grips with disclosing under the framework of the TCFD, the Task Force for Climate-Related Financial Disclosures, and are now needing to get their heads around other things such as transition plans that they need to disclose. So we are all on a journey, and this journey needs to allow financial institutions to adequately manage and mitigate their financial risks, reduce their climate impact, and plan for their clients' longer-term success while doing their part to support this global transition to net zero emissions. So this journey for most financial institutions starts with fundamental carbon accounting, doing some scenario analysis, selecting benchmarks against which they can then set targets, and then also move forward to thinking about transition planning. And this is the journey that we're going to talk about now on this panel. So I'd very much welcome to the stage Abimbola Agbejule, who is the Head of Corporate Sustainability at Wema Bank. So we've got a representative from the commercial banking sector, Dylan Hauser, who is the African Regional Lead and the Netherlands Coordinator for the Partnership for Carbon Accounting Financials. You may have heard that referred to as PCAF. It's a very fundamental tool for doing the carbon accounting. And Saphira Patel, who is the Climate Change Manager at the British International Investment, representing the development finance community. Okay, so welcome panelists. Abimbola, I'd like to start with you, please. So, I mean, as we hear a lot, Africa's only responsible for about 4% of global greenhouse gas emissions. And obviously, historically, emissions have been very low. Currently, emissions are very low. So some people ask, you know, why should the continent decarbonize? And you are from a commercial bank based in Nigeria. What do you see as Africa's private sector's role in that decarbonisation journey? And, you know, is there a business case for it?
Thank you, and good morning. I must actually thank all the organizers. Well done, and the sponsors. It's actually a good platform for us to discuss all of these issues. And previous speakers have mentioned so many things about Africa. Indeed, we contribute only 4%, but we must be concerned about decarbonization. It's no longer an option. It's a necessity because we are still, we're still a growing economy, we're still emerging, but we are more disadvantaged than the other guys in the West. So why should we not concentrate on decarbonizing our systems now that we have the opportunity to? So right now, it's important for us to decarbonize. Start looking at options for clean technology. We are blessed. Everybody has mentioned it earlier today, the two panels, talking about our demography, talking about resources. We have a lot of sunshine. We have water. We could use wind to power our systems, but we don't have all of these things. You can imagine a planet or, let's say, a continent that have enough resources in terms of power, how positive it would be for us, how innovative we will become, how endowed and blessed we would be. So I recall the last panel talking about how food could get to the end users, and they had to use technology. So you can imagine if there was enough power, there would be solution around storage, solution around logistics. So we don't even have a choice but to actually go on that journey. And as a financial institution, we know we are the catalyst for the economy. So if we lead that conversation and we start looking for opportunities for all of these things to happen, look for collaboration, look for learnings, look for ideas, look for solutions that is adaptable to Africa. So we're not implementing something that we cannot work with. Look for how to build technologies that will help us to enhance what we already have. And funny enough, in Nigeria, we have a lot of young startups doing great things, including building renewable technologies. So how many of these startups, how many of these young minds can we pull together to do much more so that we can grow and become the right place to grow? Because I know a lot of people have heard about the Jackpot syndrome. I don't know if you've heard about it. So Jackpot is a situation whereby a young Nigerian wants to leave the country by all means. And so because the opportunities are not there, what are we doing to enhance all of that? So power is one of it. You can imagine me going to school, coming back in the evening. There's no power to actually read up. There's no power to store what I have. So, and that's part of the climate issues that we have. Flooding is another big problem. So last year, there was huge flooding. And that was part of the conversations at COP28. And I was speaking to my colleague just some minutes ago that what's happening to the loss and damage fund? And so a number of communities in the Niger Delta was completely wiped off. And so we have customers that have businesses in this region, farmers, for instance, that we've invested in. Even the insurance premium that they've paid cannot cover the loss that's occurred in terms of flooding. So why should we not look at climate issues? It is no longer an option. It is very important. And to the last question around what we need to do, as in what we are doing, we also need to start looking at available opportunities. So what have been done out there? What solutions can we, how cheaper can we make it to? So currently, my country, Nigeria, we had something called the fuel subsidy. It's no longer there, and a lot of SMEs use generating set to power their business, to run their businesses. So that is no longer available. So you can imagine me, I funded a number of SMEs, but they can't run these businesses. How do I get my money back? It's a big risk. And my investors are looking at the returns on investment. So what do I want to tell them? How do I want to convince them to continue to invest in what I do as a financial institution? And how do I want to continue to support the SME? How do I ensure that there's economic prosperity in my continent? So all of these are like interwoven. There are things that we need to look at. There are things that are very important to all of us, and we must make it happen and start talking about decarbonization. The future is now. It is not an option. We must get it along. Thank you.
Great, absolutely great real-life example of how transition risks crystallize into credit risk for banks. And Dylan, the Partnership for Carbon Accounting Financials, or PCAF, as it's very widely known, provides a really invaluable industry-accepted protocol by which financial institutions can baseline their financed emissions. It's really at the foundation of the climate mitigation journey for a financial institution. So it's obviously hit a nerve because it's only a few years old and it has just grown so rapidly. And prior to this, you know, the whole idea of financed emissions was a bit of a black box, like nobody quite knew how to do it and everybody was doing it very differently. You know, why do you think it's been such a success, and what are you focusing on these days?
Yeah, so thanks for the invite, first of all. Happy to be talking about PCAF here specifically. And just to set the stage, even though you've alluded to it from the start as well, I think it's very good to explain it very briefly what financed emissions are specifically as well for those who do not know already. In this case, we're specifically talking about the emissions that occur within a financial institution's portfolio. So specifically the emissions that you enable as a financial institution through your investments, through your loans, or through insurance activities, for instance. We're still expanding upon that, so just so that this is clear. And indeed, as you mentioned as well, it's the first step generally in the decarbonization journey, because it's very important to measure before you want to set any potential targets, and before you move on to targets, to a transition planning and potential strategy after that as well. So that's why it's very important to start with financed emissions in the first place. I wanted to talk a bit about the PCAF journey as well, so that this is a bit clear. You already mentioned that it's a few years old still. It's only a few years old from a global perspective, first of all, because the story actually started in 2011 at first, because that's the moment when the Greenhouse Gas Protocol launched their Scope 3 guidance on how to measure emissions in Scope 3 for financial institutions. But for financial institutions specifically, it was very vague. It also felt very bottom down for a lot of financial institutions. It wasn't talking specifically about asset classes. It was really talking about very specific things. It wasn't talking about Scope 3 Category 15, which is called on loans and investments, as specifically as it had to be. So what happened? The Dutch central bank actually brought together a few financial institutions to be thinking about, all right, how are we going to do this better? Which led to 15 financial institutions specifically bringing about PCAF in 2015, which was Dutch originally. Hasn't been for a long time anymore since. And the Dutch financial institutions are by far the majority currently. But good to mention that. It became a global initiative in 2020 after being launched in North America. And interestingly enough, it became a global initiative by 50 financial institutions. So we started out with 50, and these were largely value-based banks. As a matter of fact, small banks, through the GABV, the Global Alliance of Banking Values, which was heavily invested in the development of this at first. So there were very small financial institutions from Nepal, smaller financial institutions from Africa as well, and institutions from Latin America who engaged in the development of this. Before larger financial institutions like Morgan Stanley started to pick this up and think, all right, maybe we should be involved and not let only financial institutions do this. So it's a very good display of what a group of financial institutions collaboratively can do to change things. Currently, by the way, moving to now, we are at 400 financial institutions currently, and hoping to grow to 1,000 by 2025. And it's really by financial institutions for financial institutions. So the steering committee consists of financial institutions, the core team consists of financial institutions, and me being part of the secretariat, including some of my colleagues, are there to facilitate. Now, why is this important specifically? Specifically the financial institutions. We need to jump back to 2015 when PCAF was founded as well, on the way to COP, by the way, on the train from Amsterdam to Paris, interestingly enough. One of the articles, specifically Article 3, was about the efforts on the decarbonization journey of the parties, of course, as well. What is the role of financial institutions in that case? If you take a look at the emissions, that can be associated with an average financial institution, specifically the financed emissions part, so scope 3 category 15, is estimated by CDP around 700 times bigger than its own operational emissions. So if you as a financial institution purchase renewable power for your offices, it's very commendable and very good, but the actual impact is actually in the steering that you can do when it comes to the portfolio. So that was the intention. Why it has been a success is because of two things, I would say. That is, it is a bottom-up initiative. As I mentioned already, it's by financial institutions for financial institutions. It's financial institutions themselves and the collaboration of it throughout a global presence in different regions that determine how is it that we want to do it, taking regional nuances into account. So it's not necessarily a regulatory perspective saying how it needs to be done, it's actually the financial institutions themselves. Also leaving a lot of room for regional nuances and regional implementation. Like PCAF Korea is currently doing, a national chapter in Japan is currently doing, Netherlands is trying to do that as well. And we're really trying to get a South African regional chapter, national chapter specifically here as well, but that's still in the making. And the other one is due to the regulation, actually. In a lot of countries, this is already being forced, enforced. TCFD is being recommended by a lot of regulators in specific countries, some even already mandatory. And TCFD also recommends to use PCAF specifically for these financed emissions. And that was approximately 2 years ago, which resulted in a large part of that growth from 50 financial institutions to 400, in all honesty.
Thank you. Brilliant overview. I hope that was useful for all of those that aren't so familiar with all of the technical sides of doing financed emissions. Saphira, coming to you as a development finance institution, how is the British International Investment thinking about supporting climate mitigation in Africa? And do you have a case, do you see the case for climate mitigation, or do you think more that adaptation or green financing is kind of more important or more appropriate for the region?
Firstly, thank you for inviting me onto this panel and to see what BII's views are on the topic. So, yes, there is definitely a case for climate mitigation finance in Africa. From a BII perspective, I mean, climate mitigation is one of the 3 pillars that we have that underpin our climate change strategy. So next to adaptation and resilience, we have the mitigation, and then we have the decarbonization, the net zero targets. So it's definitely up there. I don't think it's a case of mitigation is more important than adaptation, or we need to focus more on one or the other. It's about getting the balance right, but ensuring that we do decarbonize while also ensuring that we facilitate the adaptation and resilience of our societies and communities going forward. So there is most definitely a case. And the way BII has incorporated climate mitigation and mitigation finance into everything we do, we have the climate finance methodology, which is aligned to the MDB methodology and based on best practice. We also have our climate change strategy, we have a net zero approach, we've got a gas guidance note specifically focused on Africa, transition guideline for Africa specifically. So it really is fully integrated into what we do. And the other element of what we do is we invest in climate finance, mitigation and adaptation across all sectors that we operate in Africa. And I think one of the good examples of how we do this and how it's integrated into everything we do is that I mentioned yesterday we have the Climate Innovation Fund, which is supported by the UK government. And part of the fund, we've been able to fund other funds, such as the Equator Africa Fund. And yesterday I gave you the example of Sun Culture. So Sun Culture speaks to adaptation, but it also speaks to mitigation from the perspective of its renewable energy that supports so solar power pumps for agriculture. So that brings in your emissions reduction element as well as your adaptation elements there. Another really good product we have is we've partnered with Zanaco in Zambia, where we're funding SMMEs and climate solutions with a focus on renewable energy and emissions reduction again. So it's maintaining that balance between not the two, but making sure that we not only support our investees, but we also enable them to decarbonize while we also decarbonize our portfolios. I think another really good example of other work we're doing within climate finance and mitigation in Africa is we've got energy as a service as one of our solutions for Africa. We've working in the mini grid and hybrid grid solutions as well for Africa, especially to try and extend energy services into rural areas. And then we also have a really good resource efficiency program where we specifically go in and look at certain investees or our investees who require it, look at the organizational, the operations, and see where we can support them to reduce their emissions over and above. So it could, for example, be maybe we funded, say, a coffee mill. And then we'd go in afterwards and say, right, if we look at your operations, we can reduce your emissions by X%. If we do X, Y, and Z. Maybe it's a combination of solar PV with a battery backup or something along those lines. And then we can work towards putting concessional finance in place specifically for that. So that decarbonizes with our investees. It helps us to decarbonize our portfolio. But at the same time, it provides a solution, a workable solution for businesses to continue to operate in Africa and continue with the development and the growth that Africa so desperately needs. So absolutely. And then maybe one last point is, from BRI's perspective, I think there's a very important role to play within mitigation finance in frameworks, development of frameworks, supporting of frameworks, alignment with frameworks. And there is a great deal of movement in the market as well now to see what we can do within a transition finance perspective, which again speaks to our decarbonization, but what exactly is transition finance? How are we incorporating that into our funding, and what are we going to do about that? So going forward, that's another area we'd be looking into.
Thanks, Saphira. It's great reflections, and shows that you really have to have a kind of multi-pronged strategy where you're looking to fund climate solutions, help existing clients to decarbonize, and think about those very carbon-intensive assets and how they might be able to transition, if at all. So, yeah, absolutely brilliant. And I think, as well as it, you're showing that it's not just about providing the money. Your institutions have a huge role to play in really capacity development within the real economy as well. So it's not just money; it's also advice and know-how and training and capacity building. So, coming back to you, Abimbola, Wema Bank is a member of the Principles for Responsible Banking. You're also Africa's first fully digital bank, I understand, and you've been really making waves when it comes to financial inclusion. But how are you thinking about climate? Have you been able to start thinking about financed emissions, like as Dylan was talking about, or is that still, quite challenging for a bank in your situation?
Okay. Yes. We've been a member of PRB. So in fact, we're one of the founding members. We signed up in 2019, and that's really aided so many things that we do as a bank. So when it comes to PRB, there's a lot of support, and what they've helped us to do is to map out our area of strength, our area of materiality that relates to our country as well. And so we had picked financial inclusion and women's economic empowerment, and that's why you see things around financial inclusion. And for us, when you say we're Africa's first fully digital bank, we're the first bank that was able to demystify banking. And so what does that mean? You don't have to go into the banking hall to open an account. You don't have to fill a form, a paper form. You don't have to come into the banking hall to request for a bank card. You can do all of these things within the app and within 5 minutes. So you just take a selfie and signature, then you link it to your bank verification number, which is unique to Nigerians that have bank accounts. And so this was done to actually attract the younger demographics. Don't forget, in Nigeria, 70% of the 200 million people are youth. And what I mean is that people within 18 to 35 years. And so these are the sort of people that are supposed to help us to move Nigeria to the next level. So we used that to attract them, and that actually gave us the opportunity and to become Africa's first fully digital bank. I think with that, we've been able to onboard over 5 million customers, and that's like the most, the simplest ways to onboard people, because looking at building brick and mortar, the facilities that you're going to build, the power to actually keep the building running, the other facilities that is required, and all of those things. So that makes us think about climate. So we were saving a lot in terms of not printing paper, brick and mortar branches, and also building efficiencies around how we operate. And so for us as a bank, we have a resource efficiency platform where we actually monitor our usage of water, power from the grid, power from diesel, power from transportation and commuting, I mean using our pool cars and all of those other things. So we monitor that closely so that we are within the target that we've set for ourselves in terms of emission. And so doing that, we have at least 30% of our branches are powered by solar. We have energy efficient light bulbs and appliances within our buildings. We also do a bit of daylight savings in terms of using glass, and so we don't have to use a lot of power. We're doing that internally, but we started to look at our customers as well in terms of financed emissions. And so when we do, we're able to capture scope 1, scope 2. I'm sorry, a couple of people understand what I'm saying, emissions. So for scope 3, we're just going into that for our customers. They're saying, if we're financing you, what are you doing in terms of reducing emission? Is it about building effluent water systems so that you're not consuming too much water? Is it about transiting to solar or other forms of renewable energy? We have some of our customers on CNG rather than using a fossil fuel. So are we financing them? What do they need? We started doing that. And for us to scale in terms of doing that, there has to be a lot of capacity. They need to understand from their own point of view by teaching our customers why we're doing this. Why are we trying to save the planet? Why are we trying to get you to reduce your water consumption? Why are we trying to get you to change your packaging, move more to paper packaging than to use plastic? Because those things are not biodegradable. And so a lot of education has to go into this. But we can't do it alone as a financial institution because there's so much capital that we have to run all of these things. Also, our promoters and investors are expecting returns on their investment. And this is supposed to be long-term investment to our customers, because obviously you cannot pay back while trying to sustain your environment in the right way as faster as people trading in oil and gas. And so we have to meet halfway, but we're considering it significantly. We're working with some of our corporate banking customers, especially the large one, manufacturing and people. So we're teaching them how to do it, what to do, why we're doing that. And also not telling them that if we're able to do this successfully, we have a number of DFIs that are willing to come in and invest in them and also help to reduce the cost of capital. So, so all of these things work together, and we started doing that. And beyond looking at their climate emission, we're transiting to CCFD. So NGX, as a Nigerian Stock Exchange, has made it mandatory for banks or institutions that are listed on the stock exchange to start reporting on their sustainability activities. So if you see a financial report from a bank that is listed, you see things around climate, you have to declare. What do you put in a lot of E&S considerations to your lending? So it has forced us as commercial institutions to start looking at both our internal emissions and also our financed emissions. So those things are very, very important. But for us to do this success, we still need a lot of collaborations. A number of banks are member of PRB and UNEP, and we're all trying to come together to learn, to build platforms, to build single tools, because we have different tools for measurement. So if it's standardized, it makes it a lot easier for all of us to actually go along to say. And so we're also looking up to PCAF to learn some of the things that they're doing and start adapting and adopting them. And over a period of time, I'm sure we move to a good situation whereby our customers, the big one, even the small ones, will understand why we're doing this and start calculating these emissions on their own. So we want to build it. So some of them have started. One of our customers is called BU Power. BU Power, what they do is to supply energy to a university in southwestern part of Nigeria. So we've taught them how to calculate their own emissions in terms of what do you generate, what do you consume, what is the impact on the environment, what's the impact on the people around you, are you able to provide power for people beyond the school community that you're serving, you know, so all of these things endear the communities to them. They also see the reason why they need to do much more. And so how many of these sort of customers can we build and actually equipped to do much more of this? So this is an ongoing conversation, it's a journey, and I'm happy with the place that we are now, and I believe that as we make progress, we'll continue to report effectively. Also give out accurate data, because that's actually very important to a lot of our investors, and maybe work with more people that are doing this successfully as well. Thank you.
Thanks, Abimbola. It's great to hear how, you know, this kind of mindset is rippling out from your institution. And, you know, you mentioned the technical value of PCAF. Dylan, coming back to you, I can't tell you how many emails I get from members of the Net Zero Banking Alliance asking me technical questions, you know. Oh, we're doing our financed emissions and I don't know what to do with this asset class. I don't know what to do with this banking activity. What about this sector? You know, there's particularities around each sector, and oh, how do we deal with all the different greenhouse gases? And there's just endless questions, and it's very hard for us to know where we should be putting our effort. But looking ahead, how are you thinking about this? Where are you giving your attention? And you know, do you have a view on, say, the level of prescription that we should be getting down to? You know, because there's almost an infinite level of granularity. Or do you want to stay a little bit higher level? Yeah.
Very good question. First of all, Abimbola, we would love to welcome you to PCAF Africa. So let's continue that conversation after this session. And when it comes to your question, so we get those questions as well, Sarah, very often, of course. Because given how relatively new this space is, it has been very challenging. Again, a lot of new acronyms. Again, a lot of new things that you have to do. Where does sustainability sit? Who is responsible for these calculations that have to be done? There are so many difficult questions that you need to answer, you need to figure out internally. And a lot of organizations don't have the bandwidth to go about doing this. Over the past 24 hours, I've been talking to financial institutions here as well about this topic specifically, and some people have been telling me some amounts that they have paid for external consultancy companies that have been doing this, which have been extremely astonishing, if I may say so, very bluntly. But I understand. I really understand. It's difficult. So what we are trying to do as PCAF, and that's one of the rules as well, as you start becoming a part of PCAF, we always say, start as small as you want. So there's a commitment, that's the only commitment when it comes to PCAF, is that you actually try to disclose emissions within 3 years of time after signing a commitment letter. But there are no specific demands on the percentage of your portfolio that you're actually trying to measure, the sector. That's actually completely up to you. If you only want to do a small bit, just to make sure that you can understand the process and how to go about it, that's completely fine. Because it really needs to be a learning-based approach that you gradually must do in accordance with the possibilities that you have internally at your financial institution. Nobody's going to point fingers at you saying that you need to do it that way or that way, as long as you try to follow the standard and try to do it a bit and learn from each other as you go. So what we are trying to do as PCAF, more specifically, is this summer we will be launching an e-learning platform specifically. It's quite dense, quite tough, to be honest. But so it might take a few days. I can't say too much about the time commitment yet, because to be completely honest, we're still in the final phases of development. So that's why it's going to be launched probably towards the end of the summer. And it might take a few days, but I don't think those few days of somebody within your team or two people within your team amount up to the expenses that some financial institutions have to pay to those consultancy companies that are actually doing these calculations. Which the intention is going to be that you actually get somewhat of an accreditation, saying, right, you are skilled at PCAF, you're skilled at doing greenhouse calculations and calculating the impact on climate that you have through emissions. And that's largely in line with the capacity building discussion that has been going on for the past 1.5 days here as well. It's not the intention that an external consultancy company is doing it. As a matter of fact, we want the financial institutions to do it themselves. I already mentioned at the beginning, PCAF is by financial institutions for financial institutions and not there for consultancy companies, at least initially. Because that's another thing that we are trying to do, though. And that's that's something we try to do to make sure it gets easier as well, because we still understand that financial institutions do use consultancy companies to do these things. So we're trying to build the capacity there as well. Second priority, a bit less important, but it's still upon the agenda because we still see that also external consultancy companies do this wrong sometimes. So we try to make it a lot better and a lot more accessible for them as well. One other thing to make it a bit easier, PCAF has a database as well with a lot of emission factors. So these emission factors are there in the most simple version. First, you can take exposure to a specific company in a specific industry, use an emission factor for that industry, and you get an estimation of the emissions. That database currently has largely been focusing on Europe, US, specific Asian countries, but not that much. South Africa is in there, and general, regional African emission factors. So what we're trying to do, we're very glad that we have a new PCAF database team with an African member as well, who's going to really focus in the upcoming months on trying to get new data in there, new emission factors for individual African and Middle Eastern countries to actually have a more decent estimation of what the emissions are that actually occur within that portfolio. And lastly, we'll continue the regional meetings. So the regional meetings are already there, trying to put the financial institutions that we currently have in Africa together in a room, virtual most of the times, considering the distance between those offices quite often, to be discussing what are the things that you're doing. And it's really an open learning platform as well, keeping antitrust completely in regard, of course, and making sure that that doesn't happen. But still learning from one another, having presentations from one financial institution to another. How did you go about doing this? What are some learnings that you can share? And it has been very successful so far.
Yeah, I think, you know, we have a lot of discussions with members in developing countries about the difficulties of getting consultants, even, I mean, aside from them costing a lot of money, just even finding people that have that expertise in that country. And also we hear from members a lot about the real need to get a lot more granular on these impact factor data points. Because you can't lump African countries together. You know, they're all so different, have different sort of energy systems, different sort of maturities of different industries in different sectors and things. So getting that granularity for sectors within individual countries will be absolutely fantastic. And I know one thing that we're in the Net Zero Banking Alliance really looking forward to PCAF developing is the approach for capital markets. At the moment, you know, our members have been very focused on their lending and investment portfolios, but obviously, especially in the fossil fuel industries, capital market activities, so the issuance of debt and equity is a massive part of what they do, and they need to start taking those emissions and attributing them to themselves as financial institutions. So we look forward to that. Let me come on to Saphira again. So we heard a little bit about the role of DFIs, and Abimbola mentioned that, you know, she likes to be able to bring DFI funding through to clients. But what's the role in the journey for you? Is it, I mean, we heard a bit about capacity building of clients, but also intermediary financial institutions that you work with, or is it all about reducing the cost of capital? I think we heard in a panel this morning about the really high cost of capital across Africa to make those green projects feasible. Or is it really supporting early retirement of carbon-intensive assets that can't really transition? Or is it really about sort of investing directly in green growth? Or is it a bit of everything? How do you see it?
So I think it's a bit of everything. Or maybe to rephrase it, it's got to do with DFIs are very well placed to play in different spaces and have the ability to do that very well as well. So again, it speaks to what we discussed yesterday, which is the collaboration. So DFIs have the ability to pull together various actors within a space, various sectors. They can act as a bridge between the public and the private sector quite easily. They're very well capacitated to do that. And I mean, they're also very well placed to mobilize capital and to crowd in and leverage capital into, say, a program or you know, specific platforms that you can use as funding platforms. So I think they are very well placed. They have you know, multifaceted benefits from working with DFIs. I think in addition to all of that, DFIs do play a key role in de-risking. So if it comes back to some of the discussions we had yesterday, a lot of the climate tech and the climate solutions are quite nascent technologies. We're using quite nascent or new models, financial mechanisms, and in order to pick up that risk, to support the development and to support private sector and help private sector move into that space, I think DFIs really do play a key role there, and the crowding in impact as well. I think additionally, and I've seen this in certain regional DFIs, I think we've got somebody from DBSA here in the audience. DFIs do play a really key role from a programmatic approach, to channel funding through DFIs, to help to support DFIs in the programmatic work that they do at a regional, national level, at a municipal level as well, and also to see how DFIs can work in the implementation of especially just transition JET-P projects. So, using a DFI to bring in various different financial flows to implement specific programs and projects. I think then it also brings me down to a bit of a interesting, well, I find it very interesting, maybe controversial sometimes, in that DFIs can play a really important role, from my perspective, in transition finance specifically. Because we do know that in transition finance, we're going to have projects that fall through the cracks or that nobody wants to pick up because they would maybe for a shorter period of time or for a period of time involve increased emissions or involve emissions without any reduction of emissions being involved. They may not fit neatly into our climate finance protocols and methodologies. So who's going to pick up those projects? Most banks, we're pushing financial institutions to have fossil fuel funding policies, to have, we do not fund fossil fuels, but within that space, we do have these projects and these sectors that have to transition, and they can't transition overnight. So I think DFIs could play a really key role in doing that. And I think one of the elements of that is a very responsible role, because you don't want your carbon-intensive assets sitting with an not saying everybody's irresponsible here, but with an irresponsible investor who's going to not monitor what's happening with the emissions, not make sure that the transition plan is being implemented. So you do need the strong actor and that strong role to say, right, we will fund this for X period of time, we're going to transition to green hydrogen or solar, whatever it might be. But in the interim, this is how we're going to do it. We'll work with you to do that and bring the emissions down in the long run.
Yeah, it's absolutely key. I think there's a lot of concern about transition finance out there and the risk of greenwashing, the risk of it being BAU. Oh, it's fine, it's transition finance. We've got to find ways to be really robust about that, and make sure that, there are transition plans in place that are being monitored, etc. But it is super important. I mean, in the Net Zero Banking Alliance, we're really keen to ensure that there's real world impact, and sometimes just divesting assets isn't a way to get real world impacts, because like you say, somebody else will pick it up, and we call that transferred emissions, where the emissions still happen, they've just been transferred to somebody who cares a lot less about climate. So a super important role, I think. I'm going to come to the audience in a minute for questions, so think about questions that you'd like to ask the panel. And just before that, let's take a quick answer from each of you. In the Net Zero Banking Alliance, we spend a lot of time saying banks can't do this alone. They need a supportive policy environment. There's so many dependencies on other parties. Banks are stepping up and saying they want to play a role, but they can't do it alone. So if you could make one call to action, what would it be and who would it be to?
Okay, if I'm going to make a call to action, I still think that I'll call on the DFI still, because the private sector is willing to do a lot. DFIs have got pool of resources and investment that can actually be patient. Patient, I mean, that can, we can spread for a long period of time. I also call on them, and we've all been talking about collaboration here. So that's collaboration. And when I was driving, I saw something called Ubuntu, and I had to check. I am because you are. So you cannot succeed in isolation. So we still need them to come in, provide the necessary support. I understand what Saphira is saying, that you want to put your funding in the hands of the right person and somebody that is responsible in quotes. But we still need them to do what they can guide us to do it. They can actually stay on us to ensure that we implement in the right way. But they still need to give us the support that is required to make all of these things happen. And banks cannot do this alone because you're working on other people's capital. And so as much as I want to be climate friendly, I want to decarbonize, I still want to have a business. If there's no business anymore, a lot of people will be out of jobs. You cannot finance the economy. You cannot provide funding for small, medium enterprises. So you cannot do a lot of things. So I still need them to do it. So my call will still be to DFIs, that you should come on board. We should not just talk about it. We need both technical and financial assistance. So let's not stick to one side of the divide. And a lot of collaboration. We can learn from one another. We can be each other's friend. I will because you are. Or I can because you are. Thank you.
Brilliant. Well, let's hope some of those conversations happen in the margins of this meeting. Dylan, what's your thoughts?
Yes, thanks. Completely agree with that, of course. What I want to highlight here, of course, and I touched upon that at the start when I was answering the first question, that was a bit about the history of PCAF, and that actually started with 15 financial institutions, later with 50. So for me, an appeal is, and a call to action is a bit more through at the financial institutions within the region, Africa, Middle East specifically, and also the related stakeholders to indeed, and it's a bit in the broad sense, come together and determine how is it that we want to go about doing this specifically for this region. As I mentioned, it was 50 financial institutions, the smaller ones, that actually determined the whole basis of PCAF. And I'm talking about just very small financial institutions. So what is it that financial institutions can do in Namibia, for instance, collectively? What is the financial institutions in Nigeria can do? Financial institutions in South Africa? What is it they can do for the region to change the narrative that's already present globally? Let it be on target setting, let it be on transition, the just transition, greenhouse gas accounting, and how can you make sure that it works within the region, taking the nuance into account and the priorities, whether it's social first and doing something else, but the narrative needs to be created by those financial institutions and the stakeholders involved.
Right, so everybody grab Dylan over lunch. Don't let him go without having a chat. And Saphira, what's your sort of call to action or your wish?
So this is the problem with going last, because everybody says all the nice things first. But maybe if I can just reiterate, so collaboration, absolutely. Making sure we don't end up using a cookie cutter approach. Regional results, regional solutions are critically important. And then maybe lastly, where in these discussions about emissions reduction and financing have we brought in the human element? And how well are we incorporating the human? It's never going to be a just transition unless we fully integrate the human element into it. So maybe my call to action is, how about we start looking at the way we look at returns and impact and financial flows from a human element. So I think we had a question yesterday, we were like, what are the returns on that, on adaptation projects? I think we can't look at adaptation projects if we're not considering the human impact and the returns for humanity. So I think that would be mine.
Brilliant. And I think it all legitimately falls under fiduciary duties, so we need to get the investors on board with that view as well. Okay, let's turn to the audience. Any questions from anybody? Brilliant. So could we have our roving mic, please?
Just a note of caution, we have about 7 minutes to go before we need to be at the lunch venue.
Okay, let's take 2 questions and then the panel can kind of pick against those. So
great stuff.
Let's take that.
Yes, hello, my name is Simon Pfluger from Climate & Company. I ran across this new concept by 2 professors from Harvard and Oxford. It's called e-liability, environmental liability. It's an accounting algorithm that allows organizations to, well, produce auditable data, and it also looks especially to Scope 3. I wanted to ask you, Dylan, if you have heard about that, and what is PCAF doing, and if you don't know about that particular new concept, if there's other technological solutions you're looking at to help companies. I think also it was said by Abimbola to help companies to report, especially on the scope 3, which is quite complex. Thank you.
And let's take the second question here, and then we'll go to the panel. Oh, thank you.
Hello, thank you so much for very good discussions. This is a very new area for me, so I've been learning a lot. But maybe my intervention is a bit of a response to this call for DFI's engagement. Myself, I work for the European Union delegation in Rwanda. And we have, in the recent years, redirected quite a bit of our grant support into providing guarantees. So we are about to deploy several programs under our European Fund for Sustainable Development through DFIs, which are to come into sub-Saharan Africa and other developing countries to support financial institutions in de-risking investment and support with investment, particularly focusing on sustainable development, supporting MSMEs, job creation, sustainable cities, everything that we've been discussing. So there will be up to 12 billion euro available for sub-Saharan Africa until 2027. So I think my colleagues in Brussels working directly on EFSD Plus should really be part of this conversation because they are looking at how we can use grant money and maximize it by supporting private sector, by supporting financial institutions. So this is really something that we have our eyes on and are willing to support. So myself, I work bilaterally on Rwanda. Other delegations in other countries are also available to provide advice, support, to help attract these programs to come to your specific countries. So I would just say keep an eye on that, and if you need more information, I'm also available. Thank you.
Fantastic, great to hear, and hopefully there'll be some good networking here for you to achieve that channeling of those funds. Let's come to Dylan. I'm not sure, I've not heard of e-liability, environmental liability, other than in a kind of legal liability sense, but you're talking about more of an accounting sense.
I haven't heard of it either, in all honesty. It would be very interesting to learn more about it, though. So please, if we can catch up after this, it would be nice to learn more about it, if you can tell me. What has been difficult, though, is that what we often say, the beast is really in scope 3, right? So when it comes to these tools, further automation, they have been very difficult to create. We know that a lot of parties are actually doing it. We're collaborating with these parties as well on how to go about doing that. But particularly for financial institutions, that has been very challenging. An example, for instance, can be one of the things that the PCAF standard allows you to calculate is mortgages of a financial institution that you lend to a mortgage taker, of course. But doing so requires so much regional data and so much regional nuance. Energy labels can differ per country. There's so many things you have to take into account. So making a global tool, I don't know of a party yet that has actually succeeded in doing something that is really good and as good as people within the financial institution can do it themselves. There are a few parties, though, that create very minimal tools, which are very good to use and not too expensive as well, like the joint impact model, which is being co-led by British International Investment, actually, and FMO. But it's only the lowest data quality, and we prefer still the capacity build through e-learning platform, because that's where you actually get the knowledge yourself, rather just inserting data in the tool, see what's happening, and see what comes out of it. We actually prefer, if the possibility is there, of course, that you get some actual skills on how to go about calculating that. But let's catch up after this to see and learn a bit more about that.
Thanks. Okay, so let's start to wrap up the panel now. I think looking back over the last few years, I kind of feel that 2021, which was when COP was in Glasgow, was the year of the pledge. We saw great outpourings of pledges. 2022 was really the year of target setting, and we've started to see absolutely fantastic progress in banks' target setting around 1.5, and then this year, 2023, we're kind of billing as the year of the transition plan, where people are starting to think about what does a good transition plan look like and developing frameworks around that. So maybe just 30 seconds each, if I could ask you to say what you see for yourselves in climate finance going through the second half of this year up to COP28 and beyond that.
For me, I'll say it's implementation. We've heard so much. There's a loss and damage fund, there's so many things, but we want to see it implemented. We won't stop talking about it. Let's see action. Thank you.
That was exactly my point. It's exactly the same. But indeed, it really is about regional uptake. I've mentioned it just now as well. What is that you can do within a region? More specifically, if I can mention a preface there, within a country itself, to make sure how you can do that. Because the regional implementation of global things is necessary to actually turn that into action as well. A bit more than 2 sentences, sorry.
Going to make it really easy for everybody and say what they said. So action and implementation would be great, and we need to see more of it.
Brilliant. So we've got absolute concurrence among the panel. It's all about action, and it's all about appropriateness for Africa. So thank you very much. Please join me in thanking the panel for their excellent insights. Thank you.